I will be the host for this evening's First Time Homebuyer event. Thank you all for jumping on and spending some time with us. I know it's absolutely beautiful out here in Cleveland, but we appreciate you taking the time out of your day to join us. We will be recording tonight's event to make this available for you tomorrow. Please be on the lookout for an email from us with this recording, as well as your coupon for $100 off closing costs and other helpful information as you begin your home buying journey. If you have any questions during the presentation, please drop them into the chat. Send them to First Federal Lakewood. We will have a Q&A session towards the end of the presentation. I know a lot of you have already submitted a bunch of really great questions that we will try to answer throughout the presentation. And if we don't get to them, we'll definitely hit on during the Q&A session. All right, so tonight I'm going to start things off by introducing our panelists. We have 4 great people here this evening. First, I would like you to meet Doug Matthews. He's one of our area sales manager mortgage loan originators here at First Federal Lakewood. He has nearly 20 years experience in banking and the mortgage lending industry, and he's a really great guy to work with here at the bank. Next, I would like you to meet Julie Rakowski, another one of our area sales manager mortgage loan originators at First Federal Lakewood. She too has been in the banking industry for over 20 years. So 2 really knowledgeable lenders on hand tonight. We also have 2 other great resources on our panel, Matt Lynch from Belinsky Lynch Realtor Group and Emily McManaman with Erie Title Agency. Now, before we get, I do want to say one thing. Doug, Emily, Matt, and Julia are all here and all great resources. But as you're going through your home buying journey, I encourage you to shop around, look at different products, rates, maybe even personalities of people you're working with. Find people you're comfortable working with and people that work for you. So as a final reminder, if you have any questions during the presentation, please drop them in the chat. We'll try to answer them as we go, and if not, we have the Q&A session. Without further ado, I'm going to hand it over to Julia and Doug, who are going to take us through this evening.
It sounds terrific. Thank you so much, Katie, and welcome everybody. We're so excited to be with you this evening. We have a presentation for you, which we'll get started on with. It contains a high-level overview of some features of being a first-time home buyer, and it may prompt you to ask some questions at the end of our presentation. So take it away, Katie. So I'll start off with some of the pros and cons of owning a home. Right now, homes are rising in value, and they have the potential to go in either direction. So a home can gain value or a home can drop in value. If you were around in 2007 and 2008, that was a time when we saw home values decline. So it does happen, though it seems like the trend right now is on the upward trajectory. If you buy a home, you need to make payments toward a home. So a portion of every monthly payment goes to pay down what you owe on a mortgage, eventually to the point where you own the home outright. We have loans that require down payments, and Doug and I talked at length about this point. You don't necessarily need a large down payment up front on a home. We have several different options for first-time buyers that offer low down payments and a few that offer no down payments, for instance, our OFA home loans. We can get into that in more detail later. You pay taxes on a home. Homeowners sometimes can deduct mortgage interest and taxes, but there are property taxes that are assessed annually or semi-annually. So they are our responsibility of homeowners. And the nice thing about owning a home is that you can remodel your home in any way that you like versus being a renter. You might have to ask your landlord for permission to do things, paint the walls, hang pictures, etc. So one of the really great positives about owning a home is that you can make it your own, decorate it, remodel it, add a deck, and some people consider this a con, but I think it's just part of home ownership. You are responsible for taking care of maintenance and repairs when something breaks or wears out on the home. So those are just things to prompt some thoughts about what you might be looking at going forward in your journey to home ownership. Next slide, please, Katie.
Nice job, Julia.
Thanks.
So some common terms that we'll talk about. Your loan officer is going to ask you questions about your income. So where is the money coming from that will allow you to pay or make payments? So they're going to look at your wages, could be your salary, could be your hourly rate, could be tip money if you're a bartender or waitress. Could be Social Security income if you receive Social Security. It could be from investments, and it could be from pension. So there are multiple sources that we would look at, and we would be able to tell you what we can count towards that income so that we can figure out what your ratios are. And that's coming up on one of the other items. So income history, we're going to look at your proof of employment. Typically, a lender is going to want to know what your last 2-year history was. So we'll go through that. So if you've had multiple jobs over the last 2 years, all of that information is going to have to be supplied. We look at the debt to income ratio, and that's basically just a number that we figure out what your monthly income is, and it's divided into what your debts are. That could be car payments, student loan payments, and the mortgage with taxes and insurance, or mortgage insurance, PMI. And we'll talk about that on one of the later slides. So we have to figure out what that ratio looks like. And typically we want to see it at or below 43%. So you'll keep that in mind. And whoever your loan officer is will be able to explain that in much greater detail. We also look at credit score. Credit score is important because it'll determine, in some cases, what your rate is or what you're paying for that rate. So the credit score is just a 3-digit number that we're going to look at Equifax, Experian, and TransUnion when we pull credit. And we're going to take the lowest of the middle or the middle score, and we're going to take the lowest. If there's a borrower, co-borrower, we're going to take the lowest of that middle score. So if your middle score is a 700 and your co-borrower's middle score is a 740, we're going to use 700 as the score to underwrite the file. And then we'll look at down payment. So down payment can be a lump sum of cash used to pay for part of the home that shows the lenders you're committed to the purchase. Julie had touched on the previous slide. So there are loan programs available that you could put as little as 0% down, depending on what type of loan product you qualify for. So, and that's something that your loan officer will go into more detail as well. Next slide.
Thanks. The 5 C's of credit. We love this one. It helps us to remember how we qualify for mortgages. And the first of that is capacity. It takes a look at what you do for a living and how much you earn. Do you have a job that will support a monthly payment for the home you're interested in, or for the homes in a price range that you'd like to buy? So that's capacity. Capital speaks to how much you have saved towards your home purchase. Maybe you're in a position where this is the first step in your journey to homeownership, and you want to find out how much it is you need to set aside or start saving for that new home. Well, capital assesses that very item, the assets that you need to save and put down towards your home purchase at closing. And collateral, that simply means, in our terms, the house that secures the mortgage. So collateral is the property on which we lend you money, and that's what collateral means. Character speaks to your credit history. So you want to make sure, as you prepare for home ownership, you are being very careful with your credit. If you have credit cards or revolving lines of credit, you're using them gently. You're paying back everybody on time as agreed. So character is about your credit history, and your credit history dictates what those credit scores Doug mentioned in the prior slide will look like. So you want them in the best shape possible in preparation for a mortgage loan. And then conditions, the purpose of the loan and any factors that might affect your ability to repay. So what if you had some bumps in your credit history? or if you have alimony or child support or something like that. We take a look at those special conditions and take them into account when we're working with home buyers to prepare them for a home purchase and a pre-approval for that matter. So these are the 5 C's of credit. They'll help you to remember the components we're looking at when we help our customers to prepare for home ownership.
Great. The next slide is basically just an action plan. It's a budget that our borrower put together, and this is always a great idea. It'll help you to see where your money is currently going, and it'll give you an idea of what you might be able to afford as far as the mortgage payment. So that's one of the things that your loan officer is going to take a look at with you, and that's going to help them determine what your debt ratio is. So Julie had mentioned something on the previous slide about court-ordered payments, alimony, and child support. So one of the things that we would look at is if you are receiving that, have you been receiving it for at least 6 months, and is it likely to continue? And if it's stable, then that's the magic word, stable. If that income is stable, generally we can count it. If you're paying alimony or child support, the opposite's gonna happen. We're gonna hit you with that as a liability. That could affect your buying power. So before you start looking for a house with the realtor, one of the things they're gonna ask you is if you've talked to a lender and gotten a pre-approval. Everybody's busy right now, especially the realtors. So they don't want to waste your time or their time. They want to make sure that you're going to qualify for the loan if you don't have the ability to pay cash for it. And most of us don't. So we've got to obtain some type of financing. So one of the items on here is credit card payment. So we're going to look at your credit card debt, and we're going to look at what those monthly payments are. So let's say we need to reduce some of your monthly liabilities in order to get your ratios down to where you qualify. We may recommend paying off a credit card or two in order to get that ratio back in line. So your loan officer is going to be super helpful in explaining that to you so that you'll be able to understand that clearly.
Can I add something, Doug, for
Sure.
this slide? You said it beautifully, but we have Christina, and she wants to buy a house for her and her son, and she's got that big credit card payment of $1,000 a month. That's a house payment for most people. So you're exactly right. If we see something like that, we're going to say, it would be easier to qualify if we got rid of that. How soon do you think you could pay that off? So if that's something preventing one of our customers from qualifying for a home mortgage, we'll go and try and help and develop an action plan. And so this jumps out to me because that's quite a high credit card payment on a monthly basis.
Yep. Thank you, Julia.
Sure. And here we have Marta, and she's got credit card debt too. She's got a debt to income ratio that we're trying to calculate, which includes a car payment, student loan payment, and then credit card payment. So she has monthly income, and the way we calculate a borrower's debt to income ratio is we add up all of those expenses and we divide them by the total monthly income. And we look at gross monthly income for this ratio. That means your paycheck before the taxes are taken out of it. So you may want to pause when you're trying to determine how much money you can afford, because we base those numbers on the gross income figure. But remember, you get in your checking account the net figure, which has the taxes taken out. So we can get into that in more detail if anyone has questions about it. But your debt to income is simply adding up all of your debts and dividing by your gross monthly income.
Doug and Julie, I have 2 questions. I think they kind of go with the slide before and this slide. One that came in was, how do you determine a monthly payment? What monthly mortgage payment? Finding something you're comfortable with.
So this is a good slide for that question, Katie. Thank you for whoever posed it. The monthly mortgage payment is going to be a function of both the debt to income ratio and what's left over in the monthly budget. We like to see payments at no more than 43% total debt ratio. That means this student loan payment, the car payment, the credit card, and a house payment, which includes principal, interest, taxes, and insurance. We want to see that really at no greater than 43%. That's our comfort level. So I hope that addresses the question. We take into account all the debts and add it to a new house payment, divide it by the monthly income. That's a great question.
I'm going to add something as well.
Yeah.
So the student loan payment question comes up often. So right now, most of you who have student loan debt it's in deferment. So even though you're not paying anything as a lender, we still have to calculate what that payment will be, because at some point it's going to have to go back into repayment. So depending on the program or loan type, we will either use a 0.5% or 1%, and we're going to add that together with your other liabilities, and that's going to help us determine what your debt ratio is. So there are times where you may feel that, hey, I can qualify for this, but you've got $100,000 in student loan debt, and right now it's in deferment. So we're going to have to figure out what that payment's going to be. So just keep that in mind. And again, whoever you talk to, whoever the loan officer is, will be able to break that down pretty quickly for you. All right, so credit score, we kind of touched on this. It's a 3-digit number that reflects a person's credit history, and it predicts the the person's likelihood for the lender, the likelihood of if you're going to repay the loan and you're going to repay it on time. So the higher your credit score, the better. So this is not like golf, Matt. This is higher scores are better. So what affects your credit scores? So your payment history, how well you make those payments on time, the amount owed, length of credit history, so how long you've had credit, types of credit used, and new credit. So one of the algorithms that the 3 credit bureaus look at to determine what your score is they're going to look at the ratio between what your limit is and what the balance is that you owe. So for example, if you have a credit card with a $1,000 limit and you have it maxed out every month, that's going to have a negative effect. It's going to lower your credit score. And that ratio, the best ratio in there is about a third of whatever the balance is. So if you owe 1,000, you want to keep that balance to basically $333 or less per month. The best thing obviously is to pay it off every month. So keep that in mind. So how do I check my credit score? And that's a great question. So there are a number of places you can go to get a free credit report. You can go to freecreditreport.com, Experian.com, checkmyscore.com, or annualcreditreport.com. And you have the ability to get that score usually once a year for free. The other way is call one of the loan officers at First Federal Lakewood, and they'll work that up, and there's no cost for that either. So we'll actually pull a tri-merge credit report and let you know what your scores are. So the guys that work here all have pretty good history as far as length, how long they've been here. There's not a whole lot we haven't seen. So they should be able to help you pretty quickly determine what's going to assist you in getting those scores up if the scores aren't where they need to be, so that you can eventually qualify for a purchase.
A quick question for you, Doug, that I get a lot of time out there with clients is, how does a pool of the credit score affect their credit overall? Soft pools, hard pools. So that's a common question I get. Can you talk a little bit about that?
Sure. So we're going to do a hard pull, and it can have an effect on your credit. So if you're calling 5 or 6 lenders over a 3-4 month period, every 15 days or so, you're going to get hit with a hard pull again, it's going to effectively lower your score. Now, depending on what your score is, it could affect it by 3, 4, 5 points. It's a good idea to not have it pulled multiple times over a longer period of time, if that makes any sense. So if you're shopping 2 or 3 lenders within the same week, you're generally going to be okay. You'll get hit one time. There'll be a hit for the hard pull. The other ones don't really have an effect. But outside of that 15 days, then it's going to affect again. So that's a great question, though. If you're a 750, 760, 770 borrower, it's not going to have much of an effect. If you've already talked to someone and you're a 620, 630 credit score, I would be careful. You want to work with someone who knows what to do to help you to know what to do in order to get your credit scores up. And a lot of times it's just simple. It's just giving you the knowledge, arming you with the facts to know what to do.
Doug, what's a minimum credit score for a loan?
What's the minimum credit score? So every lender is a little bit different depending on their investors. So typically for a conventional loan, 620 is the minimum credit score. But keep in mind that 620 can affect your interest rate, your cost. It can also affect your mortgage insurance. There are loan level price adjustments through Fannie and Freddie that will have adjustments to the rate. But 620 is the lowest that you're going to get an approved eligible. On FHA or VA, you're really looking at a 640 credit score as far as what the minimum will be. So there are some lenders out there that will go down to 600 or 580 in some cases, but there's been some changes because of COVID where a lot of those investors now require at least a 620 or 640 credit score. And if you have just to give you an example, when I talk to someone and I look at their credit and I see that maybe they have a 610 or 612 credit score, but overall it looks to me like, based on my experience, they're going to qualify. I might not be able to do that loan for them here, but I'm going to refer them to someone I know in the business, because when you've been doing this for 20 plus years, trust me, you know a lot of people at other lenders. So it's pretty simple just to say, this is what you need to do to fix it. However, if you're set on getting this right now, understand it's going to affect your rate. It's going to affect some cost, but you could probably get this done. I would reach out to so-and-so at this lender. They should be able to help you.
So the reverse of that, on the high end, what's a good credit score in terms of what will get you the best product and pricing that we offer at First Federal Lakewood?
Yep, 740 or higher. 740 credit score.
Awesome.
Doug, I also have a question that came in. And I know we haven't really gotten to the kind of the home buying process. But let's say I'm in the market for a new car and I also want to get a new car while I'm buying my home. Is that going to be an issue?
If you're working with another lender, go for it. If you're working with someone from First Federal Lakewood, probably not the best idea. If you're going to buy a car and you're looking to buy a house, we're going to recommend you wait to buy the car in most cases. Or not necessarily a car. Hey, I put an offer on a house and I'm going to Home Depot to pick out appliances, and I'm going to open up an account for a stove and a refrigerator. All of that stuff, we're going to say, no, don't do. So.
Thank you.
Sure.
All right, we'll get into home buying costs next. As a first-time home buyer, you probably want to know, okay, what is this going to cost me? And there are a couple of different buckets of money that you need to watch out for. Be aware that when we talk to first-time home buyers, they usually come in thinking, okay, I just need my down payment. I just need 3% or 10%, and that's it. That'll do it. So they save and they don't save enough as a result. So be advised that you'll need to save for your down payment, for miscellaneous costs, which may include inspections. You might want to have a pest inspection. You may want to have a home inspection, which we all strongly recommend. And then you'll have closing costs. And we have Emily on the call from eReview Title, and she can speak a little bit more at this point about some closing costs, if you don't mind, Emily.
Oh, sure. I'd be happy to. Thank you, Julia. So with regards to closing costs, it's very dependent on what the actual purchase price of the property is. Generally, if the purchase price is higher, sometimes some of the closing costs are higher as well. We like to say it's usually about, you can kind of estimate about 3% of the purchase price is about what your closing costs will be. Also keep in mind that part of those closing costs are the lender's closing costs as well. So depending on the lender that you choose, you know, they should be able to let you know what those costs are upfront so you kind of have an idea. I hope that helps.
That's excellent.
It's kind of general, but
and Emily's right on. We're going to give you an estimated closing cost quote. You can also ask any lender you're working with for a loan estimate to get a detail on those figures. Closing costs can include taxes and insurance for the home and escrow expenses. So we'll get into more detail on the home buying costs themselves. Thanks, Emily.
All right, home buying costs, down payment. So down payment is the initial cash payment towards the purchase of the home. It's typically between 3 and 20%. So there are some programs available where you could put less down, and we can go into more detail and talk about that. So in our example here, Marta wants to buy a house that costs $80,000. So having a down payment can affect her interest rate and other costs. So it does have an effect on rate. It's usually pretty small, but it will have an effect. So 20% down will avoid mortgage insurance. Less than 20% down, you will have some type of mortgage insurance. There are some options for that. And the mortgage insurance, there's a slide in here that Julie will go in a little bit more detail. It basically protects the lender if you default on the loan. So one of those questions that you're going to want to ask your loan officer is, how much do I need for down payment? So on a conventional loan, there are some programs that will allow you to do 3% down in some situations. Typically, it could be 5% or more, but you may not have 20%. Don't let that scare you off from looking at what it would take to purchase a house, because there are some awesome programs out there. OFA, which is Ohio Housing Finance Agency, has down payment assistance. There's also a really awesome program that's actually taking place right now. It's called Welcome Home Grant Funds, and it's $5,000 towards down payment and or closing costs. And if you're a veteran, it could be as much as $7,500. Now, that money typically is available starting on March 1st, and it goes pretty quickly. So that typically runs out in sometime in May or June. My guess is this year it's probably going to run out May earlier. It may or earlier than that, just because the buying season hasn't technically started yet, but it's still busy right now.
All right. So miscellaneous home buying costs, we threw this slide in because it's important to consider all of the things that you may need to account for money-wise when you're buying a home. It's not just money when you buy the home, but there is an investment to consider after you already own it too. When you're buying a house, some of the things you'll see charges for on your loan estimate are the cost of our credit reports. We go out to 3 credit reporting agencies, TransUnion, Equifax, and Experian, and we grab a copy of your current credit report. They send us an invoice for that service. Inspection costs, if you have any sort of inspection, you'll pay a home inspector, for example, to go out and look around and make sure the house is sound and structurally good for you to buy. So that's an important step to take and expense to incur. We arrange for the appraisal of any of the homes we finance. So we will pass along to you the cost of that appraisal service, and you'll also receive a copy of the appraisal report. We do an appraisal to make sure that the house is worth what you're paying for it, that you're not overpaying for it. Especially in this market, it's really important to ensure that the home is worth what you paid on the price or on the contract for it. So we'll do an appraisal, and you'll receive a very detailed report afterwards. Earnest money. This is money that you give when you make an offer on the home to purchase. Usually you've come to see one of our lenders or Doug or myself, you've gotten pre-approved, and now you're ready to go out and work with Matt or your realtor and find that home. You find the home of your dreams, you're ready to move forward. Your agent will help you to write up and construct a safe and sound contract for offer for purchase, and you'll pay some earnest money. So you'll write a check with that offer and present your pre-approval letter. This shows the seller that you're serious about buying their home. Repair costs. I love this one because anybody who buys a home with a front lawn is probably going to need to buy a lawnmower. So lawnmower, cans of paint, those are things that you have to consider and set aside money for after the fact. So ongoing costs, these can be loan-related expenses like private mortgage insurance, your homeowner's insurance, and so on. I love this slide because it makes you think about not just the home buying expenses, but maybe a few things afterwards too.
Matt, I have a question for you. Maybe Julie and Doug, you can jump in as well. Speaking of inspection costs, are there inspections that are required for a potential borrower to have completed, or are there suggested ones that you should have completed?
So yeah, upfront, there's nothing that's required other than if you have an FHA loan. If you're going to go an FHA loan or a VA loan, there is a pest inspection that will be required for a VA loan and possibly for an FHA loan. And then there'll be an extra when the appraiser comes out to do an FHA appraisal, they have to be also certified to do an inspection as well. Those are the only required loans. Now, I always tell people that you should get an inspection. This is the most important decision you're going to make, the most expensive decision you're going to probably make in your life. So you want to make sure that everything looks good with this house. So there is a general home inspection that most people will get done after. So that time period is we go with the house, we get an offer accepted for the house. After that, then we're going to take that next step. We usually have 7 to 10 days to go and get a general home inspection. And that's a look at the whole house. It's a look at plumbing, electrical, the roof, the furnace, air conditioning, all those items to make sure everything looks good. And if everything does look good, then you'll move forward. It's called the removal of contingency. If there might be some issues, then we'll go back to them and say, hey, we found some things wrong with the house. We might have to get these things fixed, or you know what, we found way too many things. We're going to move on. We're going to get a release signed and we'll move on to another house. But so those are all things that not required, but it's a good thing to have done. And there's just different things with this way the market is right now that some people will get inspections done and some people will go ahead and pass on those. But it's always a good idea to look at it and say, yes, we need to get an inspection done on a house.
I'd like to share a quick story. I'll say testimonial, but it's not really a testimonial. So my daughter and son-in-law bought a house in June. Matt was awesome. He went down to Columbus and helped them. But Matt also recommended that he didn't recommend. They decided not to get an inspection. Matt said, don't worry about it. If anything needs to be replaced, just call your dad. He'll pay for it. So I appreciate that, Matt. That was awesome.
That is true. and the reason that sometimes you move forward without getting inspections, and this will all be during the process, but sometimes with the way the market is right now, you might look at everything and you might say, you know what, this house is in really good shape, and we will take our chances of not getting a home inspection. You are taking a chance by not doing that, though, and you do need someone like Doug to come out to be able to make those repairs if something like that were to happen.
Thanks. I did buy a home warranty for him, so that worked out well.
Can you tell us a little bit about home warranties? Do you recommend them? Do they automatically come part of your contract?
They are set up. There is a home warranty always in a contract, but it doesn't mean that it's being offered. So there's probably about 20 to 30% of the time that the house will be listed and the seller of the house will be offering that home warranty. And that home warranty will last for 1 year. And again, it covers different things, but for the most part, it covers your appliances, your furnace, your air conditioning, plumbing, electrical issues. And there are some good home warranty programs out there that offer a little bit of an insurance policy. A quick story for you: my son just bought a house less than a year ago, had a home warranty. The day he got his keys, and it was cold out, it was probably about 30 degrees. We went in there and we did our walkthrough 3 days earlier. Went in, turned on the heat didn't work. We're like, oh boy. So we called the home warranty company. They came out, they looked at everything, and it was the blower went on the motor. They wanted to reassure that it did work before. They had to get with the other the seller to make sure the heat was working, and it was, and it just had stopped just like that. But they came out, it was $1,000 cost, and there was $100 fee for him to have them come out, but they covered the rest of the cost. So it saved them $900. So it's a nice thing to have in that first year, a little insurance policy to have during that first year, so that in case like a big ticket expense does come up, you'll have that saving grace of that being able to cover it.
Matt, what's a good amount to pay for earnest money? Is there a right amount?
There's not a right amount, but the way it usually works out is up to about $100,000. It's usually about $500. 100 to 200,000, it's about 1,000, and then everything over 200,000 is about $2,000. Now, what you need to understand with earnest money, though, is that's still your money. So the way our contract reads, every contract reads a little bit different, but the way our contract reads is we go through the whole inspection process before we even collect earnest money, just to make sure you're moving forward with that house. So we will go through inspections. After we get done with inspections, then we'll come back and say, okay, we're going to collect that earnest money. You're moving forward with buying. And then we collect it. But that money stays in a non-interest bearing account. It's still your money. And then when it comes to closing, that will go down towards your down payment. So still your money sits in the account. The reason you have earnest money is for if 30 days comes and all of a sudden you decide, oh, we're not going to buy this house, you can't just back out. That seller just kept their house off the market for 30 days. So they'll have that opportunity to collect on that earnest money because you backed out for no reason. Now, if something comes up with lending or you lose your job, there's a pretty good chance you'll get that money back. But it's there because you're showing that earnest that, yes, we plan on buying this house.
That's great. Thanks, Matt.
Home buying cost, closing costs. So closing costs are expenses over and above the purchase price of the home. Common closing costs include your appraisal fee, tax service provider fee, title insurance, and Emily's going to talk a little bit about that here. Government taxes, prepaid expenses such as property taxes, homeowners insurance, and interest for your first payment. So there's an interest per diem. Typically, if you close on your purchase in April, you will not have a first mortgage payment until June. So there's a calculation that we use to determine what that interest per diem is. So total amount of closing costs may be between 2 and 5% of the purchase price. So that's one of the questions you want to ask when you're working with lenders, is find out what their costs are. So we have a $9.99 origination fee, and we charge that on all of our purchases. Any other fees that are charged are third-party fees or title fees, government recording, your escrow startup for taxes and insurance, things like that. So one of the things you want to look at is what does the bank charge you as an origination fee? Because those fees can change. They're pretty wide. I've seen them as high as $2,000 and $3,000 with certain brokers. So keep in mind, they may offer you a rate that's a little bit lower, but you've got to compare the APR. You've got to be able to look to see what the costs actually are. Emily, did you want to talk a little bit about the title insurance?
Sure. Thanks, Doug. So title insurance is something that protects both the home buyer and the lender in a transaction and throughout basically the lifetime of you owning that home. So for owner's title insurance would protect you from any claims to the property. So let's say that a wife never signed off on a deed and in the past, and they came back and said, "Hey, I still have part ownership of this home." That owner's title insurance would protect you to basically fight that claim up to the purchase price of the property. So that owner's title insurance actually comes in handy a lot, especially when there's like prior owner issues on title. We use that often. And then also the lender always gets title insurance. And basically that is us ensuring to the lender that their mortgage is in first lien position, so that if for whatever reason, God forbid, the house went into foreclosure, they would get paid first before, any past mortgages, all that kind of stuff. So before we can even issue that title insurance, we do a full search on the property and make sure that there's nothing strange. There's no judgment liens, any mortgages. We make sure that we pay those off so that you have clean title and that the lender is in first lien position. So hope that covers it.
Yep, thank you.
That's great.
And then, hey, Matt, I want to buy a house and I want to hire you. How do you get paid?
So I don't get paid. I get paid at the end, but it doesn't come from the buyer if you're the buyer. Now, when you go to sell your house, when houses get listed, it's the selling side that pays for the realtor fees. So all realtor fees come out of the selling side at closing. There's only most realtors that you work with will have, it's called an administrative fee, and that ranges anywhere from $200 to about $450. Our administrative fee is $265. That again, that's the only thing you would pay out of your fees that goes towards me as a realtor. It goes to our company, the brokerage, Russell Real Estate. So those, the rest of the fees get paid for by the selling side, whoever listed that house.
Thank you.
So we're on to private mortgage insurance. And if you're on this call and meeting today, you're likely a first-time home buyer, and you may not have had a chance to save up a lot of money for your down payment to buy this house. So when you have less than 20% down payment, you can still buy a home. And we will use private mortgage insurance to facilitate that. Private mortgage insurance is a form of insurance that guards the bank against a borrower's default when they bring less than 20% to the closing. So some people see this as a negative and they're like, oh, wow, I have to pay that. But the positive in mortgage insurance is, oh, wow, I get to own a house before I had the chance to save up 20% down, because that would take a long time and may put off the home ownership process for quite a while. So we love mortgage insurance at First Federal Lakewood. It creates an opportunity for our first-time home buyers that may not exist elsewhere at banks or lenders who don't work with mortgage insurance. Mortgage insurance providers are vast. We work with 8 or 9 different providers right now. And at First Federal Lakewood, we offer every variety, every form of mortgage insurance that is out there to be had. So if there's one that fits your needs best, like monthly mortgage insurance or single premium mortgage insurance, we will find it and make it apply and work for your needs. Mortgage insurance, interestingly, is also something that can be paid by a seller. So I'd like to pause here and ask Matt about seller contributions. Can you jump in?
Yep, I'm back in. Okay, so that's a common theme. Now, again, it depends on the market and where we stand on the market, but there's a thing called seller concessions. So what we can do, we can structure the way we put our offer in for a property. And this, again, depends on, are we the only offer? Are we going to be in multiple offers? But if we are the only offer on this property, we can go in and say, hey, let's try and get 3%, or we can ask for a set amount. So if the house is $100,000 and we can ask for 3%, we can get $3,000 of money that the sellers will contribute towards your closing costs. And that just helps. Again, when you look at the big picture, I think it was Doug. I think you mentioned it, Doug, how you said there's pools of money, that we have to get pools of money and we take it for the down payment and for title. And so this is just more money that we can put towards. Now, are you still paying it? Yes, you are, because your offer just became, if it was a $100,000 offer that we had 3% down, or we asked for 3% seller concessions, then the seller's only going to make $97,000 off of that offer. So it does go towards, it gets added into your loan. And then where we just have to make sure that it ends up is that the house still appraises for that value that we needed to appraise for, that $100,000. But it is a way to structure an offer to make sure you get some money coming back that gets put into the loan and you don't need as much money up front. Does that help?
Awesome.
Perfect. Types of loans. So a conventional loan is a mortgage that is provided to people who meet certain criteria. So we're going to look at your debt ratio, we're going to look at your credit score, and a lot of places can offer conventional loans. Non-conventional loans would be an FHA loan, a VA loan, that would be for a veteran or a surviving spouse of a veteran. If they have the eligibility, the certificate of eligibility, they may qualify for a VA loan. And typically VA loans don't require any down payment, so you can do 100% financing. USDA is another type of loan that is designed to allow certain borrowers that meet certain criteria to qualify for 100% financing. Now, USDA is a little bit different. It does have income requirements. So USDA is really designed for low to moderate income borrowers. And USDA also requires the home to be in an area that qualifies. So it has to be in a rural area. And your lender can look at at an address. If you're interested in the house, they'll take a look at that to see if it falls into a USDA eligible area. So there's a website that they'll go to, and they'll plug your income in and the address in, and it'll tell them if you qualify for a guaranteed USDA loan, which is what the bank or lender will do, or if you qualify for a direct USDA loan. And if it's a direct loan, we're going to just recommend that you go directly to USDA. So typically it's the criteria is a little bit different for a direct loan. Most people don't qualify for a USDA direct loan.
Doug, I know you mentioned earlier about the Welcome Home program. I'm assuming everybody here is probably a first-time home buyer. Are there other first-time home buyer programs in the state or in Cleveland that they can take advantage of?
Yeah. So OFA, which is the Ohio Housing Finance Agency, has some down payment assistance. Not all of them are first-time home buyer. You may qualify. And a first-time home buyer is not necessarily someone who's never owned a home. If you've not owned a home in the last 3 years, you typically qualify as a first-time home buyer. One of the other things that we'll look at is there may be some CHIP money available in certain areas that will assist with repairs or updates to the property. Trying to think if there's some other stuff that might be available. Julia, I'm drawing a blank here.
No, I'll jump in. There's some great local funding that we use in the area. The Lakewood Home Program is fabulous for those who qualify. We compare that with FHA loans or conventional loans, and it's basically a subsidy from the city of Lakewood to buy a home in Lakewood. There's also subsidy money around the University Circle called Greater Circle Living. We pair that with a number of different loans. We have first-time buyer programs through Fannie Mae and Freddie Mac. Home Ready is a terrific first-time conventional loan program, which offers low down payment, flexible underwriting features. It allows for seller contributions toward closing costs, and it affords a whole different look and dimension in first-time buyer and home ownership opportunity. So we have, and just about every product that's out there, conventional or government loan wise. But most all of our lending staff is versed in everything that we offer at First Federal Lakewood. And we have a number of different loans. It's likely that we have something to meet everyone's needs on this call today. So.
I know we did get one specific question about loans for educators. We have a program for that, is that right?
We do. It's the OFA Heroes loan, and it
Ohio Heroes. Yep.
Teachers, firefighters, police officers, nurses. So that's a great loan program. Good question.
And one more question. Us working in Lakewood, there's a lot of old homes. I don't know if anybody out here is looking in Lakewood or Cleveland or Tremont or really anywhere you want to do some work to your home. Are there any kind of home improvement loans that we can take advantage of?
Yeah, so there's a home style renovation loan. FHA offers a what's called a 203K renovation loan. So one of the questions that comes up a lot with the renovation loan is, hey, I'm really handy and I want to do the work myself, but I want to finance that. Unfortunately, typically, most lenders will not allow you to do the work yourself. You're going to have an approved contractor, general contractor in place. And if it's FHA, they're very specific about the contractor. It has to be a HUD approved contractor. So yes, there are a number of programs available to help with renovation, and you can include that in the cost. The nice thing is that say you want to do an addition, you found the perfect location, but the house is just one bedroom too short or too small, that other than that, it's perfect. It's in the perfect school area. You love the neighborhood, but it's just got 2 bedrooms or 3 bedrooms. I need a 4th bedroom. So we will have you get an estimate for what that addition would look like from the contractor. And when we do the appraisal, we're going to include what the as completed value would be and be able to loan you money on the as completed value. So there are some awesome programs out there.
Thank you.
So I love this frame because it shows the entire home buying process in a single view. It may be a little small, so lean in if you need to, but we'll walk through it. It's 15 steps to buying a home, and it starts with a pre-qualification or pre-approval. So you reach out to your lender and you give your application, supporting documents, and you get that pre-approval in place so that your home search can begin. And your lender will also help you review loan options based on your income, your assets, your debt, your credit score. So your options will be specific and tailored to your needs, which is another reason to reach out to a lender and start that process with the bank. Then you'll make loan application once you found a house with your agent. And that means you'll submit all of your supporting documents and keep those up to date and fresh in your file. Then we will issue a loan estimate, which is a formal quote of your loan costs and the loan structure, the transaction altogether. In the meantime, you'll be scheduling home inspections, maybe a pest inspection, anything like that, to check the house out, make sure it's the right one for you and your family. Once we know that's good to go, we will order appraisal and title services. So we'll reach out to Emily and her team. They will start doing the heavy lifting of making sure that you're going to receive clear title to this property come closing time, and they will arrange for all of your title insurance as well. Then our processor will review our entire package, make sure that it's complete and all the documents we need for our underwriter to render a decision or a loan commitment are in place. And then once they are, we send your loan to the underwriter for formal loan approval. Once we have approval, we'll have you reach out to a homeowner's insurance agent to set up coverage for the house because you need to insure it. Sometimes this is referred to as hazard insurance, and that helps some of our home buyers to remember, oh yeah, that's the insurance I buy in case the house burns down and I need to rebuild it. So I hope that never happens to you, but hazard insurance is that kind of insurance. It's different from private mortgage insurance, which you recall is to insure against any default on the loan if you don't have 20% to bring to your closing. Step 10 is you arrange your funds for closing, and then your loan is sent to the closing department. This transition is marked by the release of a closing disclosure, which is a form that is a pre-settlement statement. It looks very similar to the loan estimate you saw in step 4, and it will just confirm and recap your entire loan, everything about the transaction. And we take 3 days to review that before we'll be permitted to set up a closing appointment with Emily and her team. So the closing disclosure is important. We slow down right at a point when everybody wants to speed up. And that's just to make sure we have everything accurate and correct in preparation for your closing and you're taking legal possession of the house. Step 13 is assigning. Emily or one of her fabulous associates arrange for you to come in or to meet with you wherever is convenient, and you sign all of the final formal paperwork and mortgage paperwork associated with your buying the home. Funding and closing occurs usually within 24 hours of that signing, and ownership transfers to your name, and we celebrate because you're a homeowner. So I love this slide. It lays it out all in one sheet. Emily, I do have a question. Besides arranging for title and doing a signing, what the heck else do we need a title company for? What do you guys do?
So we also handle the monies in the transaction. So we are handling when you, sometimes for earnest money, the earnest money will come to the title company. So we hold that, and it will show up as a credit in the end when you're looking at your final settlement statement. Also, we handle the money for whatever lender you choose. When we say that at the end, step 14, they're funding and closing, they will send a wire to the title company, and from that wire, we will pay the seller whatever their proceeds are. We'll pay off any mortgages on the property, any taxes that need to be paid as a part of the transaction. So it's real important step of the process. It's called what we call escrow services, but we disperse the funds. And that's about it.
Great description. Thank you.
We have just a few more minutes left, and I know we have a bunch of questions that came into that I'd like to touch on. So if it's okay, I'm going to jump over to the Q&A part of the presentation. Okay. I know one question everybody usually has is how long, I guess, do the 15 steps take? So after Matt submits my my offer and they accept it and I get the loan application, typically how long does that take before I get the keys?
Well, Matt usually does 28 or 25-day closing. So no, I think Matt's awesome. 30 days is not unusual. 30 days is normal. During peak business times, 30 days may not be possible all the time. So we typically ask for a few more days, 45 days, but 30 days is not unusual. We can typically do a 30-day close. So one of the loan officer, whoever you work with, one of the things they're going to talk to you about is how important it is to quickly get documents that they requested to them. Mm-hmm. So if it takes you a week to get updated pay stubs or 2 weeks to decide who you're going to use for your homeowner's insurance, that can have a pretty serious effect on that timing as far as closing. So one of the things that I'll say when I meet with the borrowers, the first-time home buyers especially, is the very last thing I'll say, okay, put everything down. I need your undivided attention. You know, don't quit your jobs. Don't go out and buy a new car. Don't co-sign for someone to buy a new car. Don't go to Home Depot, Lowe's, Levin Furniture, Lazy Boy, and open up a new account in preparation that I'm going to buy some stuff. We don't want you to do that yet. You're going to go home tonight and you're going to put your head on your pillow. And when you wake up, it's going to be the day of closing. That's how quick this is going to go. So if I'm asking you for documents, it's because I need them to get your loan cleared. So I need your help. And I don't think that's an exaggeration. Doing this as long as we've done it, it's important that the home buyer responds quickly to requests. And most of the requests are pretty basic. I need updated pay stubs. I need updated bank statements as you get them. We may have a question that came up on a drive report. Hey, there was a foreclosure that showed up. Oh, that was my mom and dad's from 7 years ago. Great. I need you to put a letter of explanation together and just let us know that. So stuff like that. Usually not a big deal.
Okay. Valerie had a question about building a new home. Can you maybe provide some color on how that process works?
Sure. Do you want me to take that one, Doug?
Sure.
Okay. So building a home involves maybe not just Matt or your realtor, but it involves obviously the builder, who is sometimes or sometimes not also the seller of the property. So you can go to a neighborhood that's being developed by a commercial builder and buy a lot and a new home to be constructed, all under one contract. Or you may find that you identify a piece of land somewhere and you also know a builder who can put a house on it. So you're buying a piece of land and you're paying for construction of a house, but it's happening with two separate parties. We have a number of different construction to permanent loans. So we do a lot of construction, especially right now with inventory being on the lower end. We will lend on conforming construction to perm up to 95% of the home value. That is the lot and the cost to build. So you can do essentially a 5% down payment construction loan if you qualify. So we do quite a lot of those every day. But building a home, it requires a little bit more patience and selection. So if you're ending up looking at new construction, know that it's a great idea. It's especially great in so much as you won't be up against bidding against other home buyers for the same existing property, and you can customize the building to some extent with your builder. So lots of different terms and options available for construction loans, but yes, we do them. Okay. So I hope that's helpful.
All right. I know we're out of time. I do have one question, and it's for Matt, and I think we got this one a lot. What is it looking like out there in the home buying world right now? Is there a lot of inventory on the market? Getting into home buying season right now too.
Yeah. So it is the number one question. And the one thing I can say is the word that I tell everybody is patience. You have to be patient. This is a life decision that you're going to be making, and you just don't want to settle. So it might take 2 or 3 or 4 or even 5 offers on houses before we get that house. But I have to tell you, I've been doing this a long time. I've been an agent for 8 years. Over the last 2 years, my partner Adam and I have helped over 300 people, and all 300 of those people end up in the home that they love. So you have to just be patient and know we will find that home. But it is right now, if you go back from 2016 to 2020, just into 21 now, just in Cuyahoga County, Medina County, there was in Cuyahoga County 8,000 listings coming in a month in Cuyahoga County. That's now down to 1,500. And in Medina County, 800 down to 400 over 4 years' time. So the listings, they just don't come in as fast. And there's a lot of buyers out there, but we will find you your right home. So you have to be patient. It is a fun process. There's a lot of information that you guys did an awesome job. First of all, Julia, Doug, Katie, awesome. You guys were great. But it's a fun process. You have to make it fun. So you want to just keep on going through the process, and we will find you that right home. And then you turn it over to First Federal or whatever lender you go with, and let the process play out to get you into your home.
Awesome. Thank you, Matt. Thank you, Matt. Thank you, Doug. Thank you, Julia. Thank you, Emily. Thank you all for joining us this evening. Like I said at the beginning, you'll see an email from us tomorrow with this information, as well as your closing cost coupon and other helpful information as you're going through the home buying journey. Thanks for joining us. Good luck. It's fun. It's fun.
It is.
Bye, guys.
All right. Thanks, guys.
Thanks, everyone.
Thank you. Thank you. Good job, guys.